Taxes in Canada can feel endless. High earners see more than half of their income eaten up by personal tax, and then there's GST, HST, and property taxes on top. It feels like the government's hand is always out. But here's the surprise that many people don't know. When it comes to small business taxes, Canada actually flips the script. And here at Blueprint Financial, we've helped a lot of business owners use these tax rules to keep more money in their pockets, reinvest in their businesses, and grow long-term wealth. And in this video, I'll show you exactly how you can also take advantage of these opportunities. But stick around until the end because I'll also cover the situations where incorporating doesn't make sense because it's not for everyone. But first, let's go over the surprise, which is Canada's small business advantage. Small business corporate tax rates are shockingly low in Canada. Federally, it's only 9%, and provinces add about 2 to 4%, depending where you live. So in most places, you're only paying about 11 to 13% on your first $500,000 of active business income, as long as you qualify for what's called a Canadian Controlled Private Corporation, or CCPC. And this is an underappreciated fact because think about it, a $500,000 limit is massive. To put it in perspective, Canada's top 1% of personal earners make about $280,000 a year. On that income, you would face a top marginal tax rate of around 50%. Meanwhile, if you own a small business that's incorporated, it could earn almost double that amount, say $500,000 a year, and only pay about 12%. And in a global context, Canada stacks up very well. At only 12% tax rate on $500,000, we beat out the US, where it's 21% federal plus state taxes with no small business discount. And the UK, where the 19% small rate cuts off at just £50,000 before it jumps up to 25%. This surprised me to learn because we're always conditioned as Canadians that we have way higher taxes than those in the US, but actually Canada is way more income tax friendly for small businesses. And beyond those low annual rates, there's another huge advantage that I'll cover later on, which is called the lifetime capital gains exemption. And that's the rule that can let you sell a qualifying small business and shelter over $1 million in tax-free gains. So here's how to actually take advantage of this low rate. First of all, is to reinvest inside the corporation. One of the biggest perks of being incorporated is that you can keep so much more money inside the company after tax. That cash can then be used to expand your business, hire staff, buy new equipment, or even build a corporate investment portfolio to grow wealth for the long term. Let me give you a simple example. Meet Larry, Mo, and Curly. Now, Curly, he is self-employed as a sole proprietor making $500,000. He did not set up a corporation though. And because all that income is essentially taxed personally, his average tax rate is about 46%. That leaves him with roughly $270,000 only after taxes. Then there's Mo, who is a very high earning employee making $500,000 a year. He faces almost identical rates, around 45.5% average taxes, and he ends up with about $272,000 in his pocket only. Now let's look at Larry, who's incorporated. His company earns $500,000 of active business income and qualifies for the small business rate. Instead of being taxed at 45% or more, the corporation only pays about 12% total taxes. That means Larry keeps about $439,000 inside the company. Compared to Curly and Mo, that's roughly $168,000 more available to reinvest and build wealth in the business. And this is why incorporation can be such a game changer for business owners, and a huge reason why Curly should really consider starting a corporation. Think of how much faster Larry will be able to grow his business compared to Curly, since he keeps so much more of his money to spend in it. And most Canadians never realize just how powerful these strategies are or how easy it is to get tripped up. And that's where we come in because here at Blueprint, we've helped a lot of Canadians structure their businesses and bridge the financial gap between their personal lives and business. So book a free discovery call with us today if you're a business owner or thinking of it, because to build the life you want, you need the right blueprint. The next way to take advantage is to use corporate investing rules. So if you leave money inside your corporation, you don't just benefit from the low small business tax rate, you could also potentially unlock some special investing rules that can make a big difference. Meet Daniel. He runs a marketing agency and doesn't need to pull out all of his profits each year. Instead, he keeps some inside his corporation and invests it. First, he invests in Canadian dividends. Say, for example, if Daniel's company buys shares in a bank like RBC and earns $10,000 in dividends, the corporation pays some upfront taxes. But here's the trick. Those taxes go into a special account called the Refundable Dividend Tax on Hand, or the RDTOH. When Daniel eventually pays himself dividends, the corporation gets that tax refunded. And the end result is those Canadian dividends flow through with no double taxation. Second, there's capital gains. Let's say Daniel's corporation invests $100,000 in stocks and later sells it for $160,000, creating a $60,000 taxable gain. Half of that gain is taxable in the company, but the other half goes into a notional account called the Capital Dividend Account, or the CDA. From there, Daniel can pay himself a $30,000 capital dividend completely tax-free. But here's the gotcha that you have to be wary of. If you earn too much passive income inside your corporation, or over $50,000 a year, it will start to grind down your small business deduction and reduce access to that 9% federal rate. So you need to be strategic with this. Next is tax flexibility with retained earnings. And one of the biggest advantages of a corporation isn't just the low tax rate today, it's the control it gives you for tomorrow. By leaving profits inside your corporation, you decide when and how much personal tax to pay. Going back to Larry, remember that his corporation paid only about 12% tax on his $500,000 of income, leaving him with roughly $440,000 inside the company. And this is where the real flexibility kicks in. Instead of being forced to hand over nearly half his income to personal tax like Mo or Curly, Larry gets to decide what happens next. From there, he has options. For example, if he wants to use it for retirement money, he can move some of those profits into an individual pension plan called an IPP, which often allows bigger contributions than an RRSP. It's essentially like an RSP but on steroids, and it's held within the corporation. And we help a lot of people set those up too. Then there's estate planning. You can use corporate-owned life insurance for tax-deferred growth and efficient payouts to beneficiaries. We also have people that specialize purely in mostly this corporate-owned life insurance for Blueprint. It can get very complex, but also be extremely tax-saving for the business owner. Then there's withdrawals. You could hold back on paying yourself right away and instead take dividends or salary in a lower income year or during retirement even. Then there's reinvesting. As mentioned earlier, you can grow the business by hiring staff or expanding into new markets or buying other assets for the business. Then there's income splitting, which is a pretty interesting strategy that a lot of people are interested in, which is employing things like family members where appropriate so you can split your income legally. But you have to be very careful with this strategy because the CRA does have some very strict guidelines for this. There's also corporate investing. So as mentioned before, you can put some of the retained earnings into an investment portfolio, taking advantage of corporate tax rules like the RDTOH or the CDA, as I mentioned earlier. The point of all this is that incorporation puts you in the driver's seat because Larry gets to choose when and how to pay taxes, while Mo and Curly really don't have that luxury. And this is probably the section where there's the most strategy involved and where we help most of our clients. And if tax savings are on your mind, check out our guide on 7 powerful income splitting strategies to legally reduce your tax bill. You can get your free guide, the link is in the description. Lifetime capital gains exemption. There's another huge advantage that many small business owners don't really think much about, which is the lifetime capital gains exemption, or the LCGE. Now, when you sell shares of a qualifying small business, you can shelter up to $1.25 million of capital gains completely tax-free. And it gets even better because with smart planning, you can multiply that exemption across your family. For example, if both you and your spouse each own shares in the company, you could potentially shelter up to $2.5 million on a sale. And add in a family trust where adult children are beneficiaries and the tax-free amounts can grow even larger. This exemption is one of the most powerful long-term wealth building strategies available to Canadian entrepreneurs if your plan is eventually to sell your business. But let me go over the catch and where incorporation doesn't make sense, because incorporation isn't exactly a silver bullet. There are some catches you need to keep in mind. First off is the cost of setting up a corporation, because there are some costs involved, which are things like the management of a corporation, which can get tedious, things like paying installment taxes and making payroll. That could be somewhat of a headache. Another key point is there's no tax deferral if you need the cash. If you, for example, need to take out all of your profits personally each year to meet your lifestyle needs, there's not a lot of real benefit, because due to Canada's tax integration system, it's designed so that once withdrawn, you'll pay about the same total tax as if you didn't incorporate, which largely negates the tax benefit of starting a corporation. Then you have your personal services business rules, PSB. If you only have one client and operate more like an employee than a true business, the CRA can classify you as a PSB, and that eliminates the small business rate and leaves you with higher taxes and fewer deductions. And the key point is to not incorporate just for the tax perks, because incorporation works best when you're actually reinvesting profits, have a legitimate business that actually generates a lot of revenue, because then you can start building long-term wealth inside the company or planning for a future sale. If you're only doing it for the tax break, it often won't make sense. But if you are a business owner, incorporation can make a lot of sense. From reinvesting profits to deferring taxes and even sheltering millions on a sale, the opportunities are huge if you plan smart. And at Blueprint Financial, we help Canadians put these rules to work. So check out our website for more details on our services. And don't forget to like and subscribe, because YouTube's picked out another video it thinks you'll love. So go ahead and check it out here on the screen.